Hi, I'm Genevieve Heyman. Mike Wahlberg has kindly agreed to hand over the reins for this Enterprising Investor podcast episode, where we'll be diving into the intersection of complexity science and financial decision making. To help us unpack these ideas, I'm joined by Richard Bookstaber, a pioneering risk manager, author, and thinker whose work bridges finance, human behavior, and systems theory. Rick has a full and impressive history in risk management, working on the buy side at More Capital and Bridgewater, and on the sell side at Morgan Stanley and Salomon. He also served at the SEC and the U.S. Treasury, building risk management structures for the Financial Stability Oversight Council, and served as Chief Risk Officer to the University of California CIO office. Rick is currently a senior advisor to MSCI. Welcome, Rick. It's great to have you.
Thanks. I'm happy to be here.
In Rick's most recent book, The End of Theory, he argues that traditional economics, built on equilibrium and rational expectations, can't explain the real world of markets. Instead, he proposes a new approach, one grounded in complexity, adaptation, and the messy reality of human behavior. And not so coincidentally, CFA Institute Research and Policy Center just released a report discussing some of these themes and their application. The report, co-written by myself and Raymond Pang, is titled Rethinking Financial Markets as Complex Systems, and it can be found on the RPC website at rpc.cfainstitute.org. So thanks again, Rick, for being willing to chat about these ideas and how practitioners need to adjust how they think about risk, modeling, resilience in the investment process. I'm very happy to have this conversation with you. Jumping in your book, you begin with the moment that Queen Elizabeth, turned to the Economist and asked, why did nobody see it coming? Referring, of course, to the 2008 financial crisis. And I'm curious, what was the moment that you realized standard risk models have really failed us?
Well, I got a glimmer of it going way back to 1987 with the dislocations that occurred on October 19, where nobody was trying to make the market drop. Everybody was trying to do what made sense for them. Behind the scenes, there were algorithms running and humming, and the market suddenly, over the course of the day, dropped 20%. Then what brought it home further was in 1998, the debacle with LTCM, long-term capital management. Some of the smartest guys out there managed to have their hedge fund disappear because of a similar dynamic that occurred. So it was clear that it's not, stupid people that are leading things to happen. It's not like people want things to go bad, but the dynamics of the system sometimes lead that to occur. And so that's really where my primary lesson came from. And then I've just seen more and more examples of it over time.
Yeah, I mean, there are different examples of it, but they all kind of come back to, I think, in your book to, this idea that financial crises are deeply human events in the sense that, humans aren't a homogeneous automaton, right? Just always behaving in the same ways. We behave in different ways, sometimes in seemingly unrational or unpredictable ways. We're driven by things like interaction, experience, and uncertainty. Could you unpack a little bit about what you mean? So in the book, you talk about, okay, well, how those dynamics of those kind of actors in the market create emergence, this term that you use. And, even when people are acting in a individually rational manner, right, it can still create this emergence of instability in the broader market. And could you say a little bit about that?
Yeah. So, the key thing in the start of the second chapter of my book, I say, as a start, consider we're human. It kind of seems like that's a nice place to start. We all have different experiences. We all focus on the market in different ways. The markets themselves are innovative and creative because humans are involved. And yet, the dominant approach that's used in economics and finance is having a representative agent. In other words, let's take everybody together and pretend that there's one agent, one person who's doing it all. So you're essentially assuming away all the interactions and complexity that occurs when a lot of people are doing what they think makes sense. So, a good example of emergent behavior. And emergent behavior basically means You can't look at the individuals and glean from their behavior what the macro result of their behavior is. The representative agent approach assumes that from the start that you can do that. So a good example is what happens if there's a fire in a nightclub. Uh, there's a lot of people there. It may be flammable. It may be that there's not many means of egress. When it occurs, each person is doing something that on their own makes sense to do, and everybody would agree makes sense to do, which is get out of an exit. But you end up with this cascade that leads to problems at the exit. And I guess if everybody were, a Marine in there, they'd all kind of behave exactly in lockstep. And it may well be that part of the issue is, can you dissipate the notion that people are individuals? But the fact is that you can't. And that analogy actually is a really good analogy for emergence and the nature of human behavior in the financial system. If you think about it, the number of people in the nightclub is like the concentration in an asset. The means of egress is kind of the degree of liquidity that's available for people to exit. And the flammability of the space is like the leverage. How much time do you have to exit? So you can take the analogy of the behavior of people in that nightclub and put it into the market when there are cases of high leverage and the spark hits that starts, the fire off.
That makes sense, and yeah, I mean, even in a circumstance of a nightclub where people are intoxicated, still, they wanna make the best decisions possible, right? And I think the same can be true for markets, right? No one's going into it thinking, "Oh, I wanna make a bad investment decision today," right? Everyone's kind of trying to navigate their own parameters and circumstances.
And one of the problems also is that the day to day doesn't give you any data or clue to what would happen when these sorts of events occur. So you can sit there and do all the statistical analysis you want, look at the returns over the last 3 years, but absent one of these events occurring during that time, you don't get any information for this type of dynamic from the behavior of the market in normal times.
Right, right, yeah. Yeah, I like the crowd analogy because, there have been instances where an event will trigger something, like someone pulls the fire alarm and suddenly, you know, people that are milling in a certain dynamic, suddenly the dynamic changes, right? Okay, so I know our listeners will be interested kind of in bringing this to a more concrete level. And I think in particular, they'll be interested in, okay, well, what does that mean in terms of the actual like models that we utilize, that we implement, as financial professionals? In your book, you talk a lot about these kind of equilibrium based models, things like CAPM, or things that, assume normal distributions, Black Scholes, certain variations of Black Scholes. But, there are these assumptions essentially in your book that traditional financial and economic models just kind of take for granted. And I wonder if you can speak a little bit more about that and what are the kind of limitations there, and maybe why, and include, any of your background from your diverse history working in different areas of the industry.
So the biggest problem, as I mentioned, is that the current models, and my focus is in risk. So I'll speak to models related to risk, value at risk, and so on. The manifest problem, and I don't know why people just live with it the way they do, is that the risk is measured based on the returns over the last 2 or 3 years. So you have to live with an assumption that the risk going forward is going to look like the risk over the last period of time. And of course, pick a particular period of time, and that probably is not going to happen. So right at the outset, you have a problem with basing things strictly on statistical methods. The other problem that we also touched on is uh, the risk models are used don't take into account the dynamics and the interaction of behavior. And I don't mean behavior like behavioral economics. I mean just somebody's levered, they're going to sell if there's a stress. Their selling will accelerate that stress, which leads them to sell more, and suddenly other people have to come in. The market that they're in is no longer liquid, so they have to go and sell something else. So you get contagion to another market that may have nothing to do with the initial market except somebody happens to hold both of them. So these sorts of things are simply totally out of the realm of what people look at in terms of current risk management practices. They can't be looked at based on a statistical analysis. It's not looking at the moving average of volatility or correlation. These sorts of things happen, and suddenly the correlation between assets goes up, not based on commonality of function, are they both in the same industry or something? It's that people who are highly levered, who will hold one, also hold the other. And the thing is that this is what matters for in times of crisis. So it's fine, the typical tools may be fine when they don't really matter. But when things really matter, they don't work anymore.
Yeah, it's a funny one. You can get really reliable statistics when the conditions are the exact same all of the time and nothing changes, but of course that's not the concern, right? And so they're least useful when we need them to be most useful, right?
Yeah.
Yeah. That's interesting. And you mentioned there contagion. So we have the kind of sense of emergent dynamics and how we're going from, a bunch of different kinds of entities in a financial market leading to these kind of changing patterns of behavior that has emergent system-wide effects. But I wonder if you could talk about, how you think about financial markets and as a networked system, right? And I think you make an analogy to a power grid that can cascade into failure, right? And systemic risk cascading is a very a commonly used term. What's the relevance of that kind of effect, or how do you visualize that sort of effect, and what does it mean for regulators and risk managers?
There's a lot of ways you can look at things in terms of networks, because networks are pictorial representation of interactions. The nodes can be people or investors. In that case, all the edges go to the market and then out from the market. It's not like Fidelity trades directly with Vanguard and so on. But the place that the networks now become more critical, and this is something that really I've just looked at over the last 4 or 5 years, is looking at the physical risk in the system, the real economy, as opposed to the financial markets. And that's where a lot of the risk going forward is really going to occur. Issues with supply chains, with effects of climate, effects of demographics, geopolitical issues, even AI are going to have systemic effects that will hit the market, but not from internally in the market, but because they change the nature of the world. And there, everything sits in a network. If you think of supply chains, you have different companies who produce different things in different locations. And those are the nodes. They have links or edges going out to other nodes, which may be companies that use what they produce as their own inputs, or it might be to the final consumer. And so if you think of laying out a map, lay out on a map of the world nodes for each thing being produced at any given location by any given company, and the links of what goes in for it to produce it and what goes out and where it goes, now you have a sense of the complexity and the network that underlies the financial system. And it's an area, supply chain analysis and so on, that really has not been treated very much in the past, but will be increasingly important going forward because of these issues of climate change and geopolitics and so on.
Yeah, that's really important, and I think it links up with some other ideas, that I know in our report, which you had kindly reviewed and looked over, I think a shift in the industry and thinking about some of these risks, there's a kind of push towards thinking about it more holistically or, from the systems level, as they refer to it. But I had someone pose a question to me recently talking about these kinds of issues. Well, okay, maybe we can appreciate that the insights that we've gleaned from traditional models have, been rather restrained to specific things within finance, and we need to broaden that scope, right? But then the question becomes, well, how far do we broaden it, right? I mean, these systems, as you say, they're all interconnected. How do we draw the boundaries for a system, right? Like
Yeah.
how do we go about and figure out, well, what are the relevant aspects of.
Well, the starting point is, what are your objectives as an investor?
Mhm.
So if you're a high frequency trader, relative value trader, where you're looking at things intraday or across various days, the issues are different. You don't care about demographics and climate and AI. My focus is more towards the area of asset owners. As you mentioned, I was the chief risk officer for University of California's system, which by the way is $170 billion. It's really surprising. I could go on about University of California. It has 10 colleges, which are basically universities. It has 5 medical centers, 2 national labs. So it's a substantial system. I really enjoyed working there with Jagdeep Bhattacharya and others. But that's where I really started to focus on the reality that what finally matters are the asset owners, you and me and our pensions, individuals saving for retirement. So if you're in that realm, the sort of things I'm talking about are dominant. The CNBC, talking points, what the Fed's doing at the next meeting, what earnings look like, it's noise. It's noise for the time frame that we're looking at. And what matters to us is what I call material risks. And I wrote a paper with Drew Sharma, that's a CFA paper on material risk. These are risks that really matter in the time frame of an individual, an asset owner. And so when you're in that realm, these issues of changes in the supply chain, what's going to happen as the Arctic melts, and we have literal sea changes in the markets. The other thing that's important as you go further out is getting back to the distributional issues that underlie CAPM and so on. We talk about fat tails, and everybody focuses on fat tails. Well, if you have a time frame of 30 or 40 or 50 years, it's the opposite. It's mean reverting. I am on the advisory committee for the Master's of Financial Engineering program at UC Berkeley. And one of the things I ask students to do is get a chart of the S&P 500 from, say, 1935 on, and look at it in return or log terms. It's basically a straight line. We have the bumps from 68 to 70 or to 81, from 2000 to 14, but it doesn't explode out the way that it should if you believe in a square root of time process. The other thing is volatility is very stable longer term. If you look at the volatility of the market from, say, 1935 on, there are jumps, bumps, up and down, but there's sort of this background radiation level that's very stable. So the mindset that you have to have if you're looking at risk long term, if you're an individual or an advisor or work at a pension fund, is much different than the mindset that dominates risk management today.
That's interesting you say that, because I think in your book you talk about the mismatching of time horizons as itself can generate additional risks as well. Yeah, I wonder if could you say a little bit more about that, about why really thinking about the time horizon in which you're operating and which everyone else is operating, including, the model that you're working with as part of that system is relevant.
Yeah. So, I mean, the easiest example of this, and I think everybody can take it to heart, is if you're, again, an asset owner and you have a longer time frame, you can step to the sidelines anytime you want. If the market is crazy, you can step to the sidelines until the dust settles because you don't have to do anything. You don't need to liquidate right away. You're not, hopefully, highly levered that's forcing you to sell. And I think a mistake many people have is they look at hedge funds as being the archetype. Oh, these are the really smart guys. No, those are the most constrained guys. They're highly leveraged. They have no time or freedom to adjust what they're doing. They have to make money and report to their clients every month. You don't have to be put into that bucket. And in fact, you can go the other way and be the liquidity supplier during these times of crisis. If you really want to be bold, don't be on the sidelines, but wait until the dust is starting to settle and then go back in. So that's a good example. People confusing what their objectives should be and what their freedom of action can be based on their time frame versus the hot money people who are in the middle of the market.
Nice. Yeah, that's great. It's an interesting time, yeah, especially given the way that investment decision making has kind of evolved and changed. We have a lot of algorithmic based trading. I'm curious what your thoughts are in terms of the kind of dynamics that and the way that the dynamics of trading have evolved. You have people making decisions and they do so according to heuristics or rules of thumb, as you talk about in your book, and they might follow more fundamental strategies. It might be based on certain kinds of sectors or research, but we have a lot of trading going on that is algorithmically determined that follows certain factors, and I'm curious, like how do you see that one, I guess, as a kind of regime shift or paradigm shift in the way that people are behaving, right? Is that a salient dynamic change? And two, like what are the kind of outcomes or what do you think are the kind of salient risks with that kind of evolution?
Well, there's always been some sort of innovation because the way you tend to make money in the markets is you think of something that people haven't thought of yet and you get ahead of the curve. The whole It's not the way this way now because the nature of broker dealers has changed, but when I was involved in that area many years ago, we would try to develop new financial instruments, quote, innovations, where we could price them better than other people. And then we could sell them and make money off of them until other people caught on and also could price them that way. That was and then you had things like high frequency trading, same story. It was, can you be faster than other people as opposed to figure something complex out? I mean, it's really kind of interesting. Finance is probably the only area where financial engineers make the world more risky. And because you can make money if you can make things more risky where you understand the risk more than other people. So we've kind of marched along doing that with different sorts of derivatives and, faster trading methods. I think we now are at the cusp of something that's really qualitatively different because everything that we've done is mechanistic. It's like you're saying, it's heuristic, it's mechanical or heuristics, it's algorithmic. Now we actually can create humans, so to speak. And I hate to say that because everybody will say, oh, no, no. But really, if you look at large language models like ChatGPT, they are very humanesque in how they can take in more information, respond to what you're thinking, adjust what they're doing. So now you, instead of having, say, in an agent-based model, mechanistic rules for somebody who is a momentum trader and somebody else who's a leverage trader, you can say, I'm going to create a market, an agent-based model that has different persona that represent different types of people in the market. Some are shorter term, some are longer term, some are more conservative, some bounce around in terms of their decision making, others follow fairly straightforward paths. And now imagine having all of these be different chatbots all interacting. You have something now that kind of pierces through that mechanistic to human layer. I've been playing around with doing that, and it's actually staggering what's possible there, and it's barely even we've not even touched the surface really in the industry, much less gone into it in any depth.
Yeah, that's super interesting stuff. I mean, the potential for AI and large language models to, in some ways, I know replicate is the right word, but produce human-like reasoning and decisions is fascinating.
Yeah, I actually just built what's called a GPT. So ChatGPT allows you to build little baby ChatGPTs that are specialized. In the late 1990s, we had websites coming around. People were designing websites. Now we have LLMs going around. People can design baby LLMs. I think creating ChatGPT versions now is a lot like what websites were then. And, the one that I've created, and it didn't take long to do, if you put it on one screen and put me on the other screen and we're conversing, with both, not knowing those two. So this is sort of a Turing test. My guess is you wouldn't be able to tell that that thing is an LLM. So it's harrowing. It's really, what does this mean for the industry? What does it mean? It's even better than a person in the following way, that it can embrace megabytes, gigabytes of information as it's responding to you in context. It can go through many models through huge amounts of information and pull up what actually is the key observation. So in some respects, it's better than sitting down with somebody who's, a typical risk manager.
Yeah, in your book and in our report, we talk about agent-based modeling, and agent-based modeling is a simulation method, but the idea is kind of, I guess, tying it all together where we started with individual heterogeneous agents who all have, are interacting with their environment and have different kind of heuristics and strategies, and that lead to this kind of emergence system-wide behavior, right? We can basically simulate many different types of agents that all have different types of behaviors because, every AI is different. Yeah.
I first got interested in agent-based models in the early 1990s at a conference at the Santa Fe Institute. And at the time, they were building baby agent-based models that they called artificial stock markets. And it was fascinating at the time. You could have very simple rules, and the mantra really of the Santa Fe Institute at the time was complex systems from simple rules. If you start with simple rules, you can end up having, bubbles and crises and so on. Well, this is a long time later, and the technology is just 1 year or 2 years old. But now we really can do that. I think the ability to take an agent-based model where the agents are what in artificial intelligence terms are agents, that are apparently living, thinking entities, apparently, not literally, but from the standpoint of how they interact within the system, they look very much like a heterogeneous set of, yeah, of people interacting in the market, and then from that, you get the sort of emergent behavior we're talking about, and, you get some intelligence in terms of how people change their reactions. So I think this is a very exciting time, and what's interesting is how quickly you can work in this area. The tools are developing very rapidly. If you decide I want to build this thing and my goal is to get it built in 6 months, you can either start now or wait 5 months and the tools will have caught up, so now you can build in 1 month. I'm not that technically, well, certainly in terms of computer things, I'm way behind the times, but I can do it because essentially the LLM, you tell it what to do and it does it for you.
Right, yeah. And that's you have written extensively about, the importance of simulation models and why, simulating those dynamics will allow you to maybe uncover some things that you wouldn't otherwise uncover, right? If you're looking to for a particular, single output. And so
Well, the problem, getting back to the whole issue of the current models, there's a lot of things that you simply have to simulate. It's called computational irreducibility. There's some things that you just can't convert into equations, and some of them are really one step away from being trivial. So the three body problem, except for a few special cases, you can't solve through equations. You have to literally march period by period through the position of each of the three bodies. There's this Conway's game of life that some people might know. It's a one person or zero person game actually, is has three extremely simple rules, and yet you can't solve generally for how it will move forward. So really, you're hamstrung much more than people realize when you're dealing with pure, mathematical equations and the regularity conditions they require. It's sort of like you've assumed away the possibility of a train going off the tracks and going down the hill. There's like an elastic band that if it goes a little bit off, it's always pulling it back. And so you can't model the things that, as I mentioned before, you really need to model the times of crisis and dislocation.
Mhm. Building off of that in that context, what's the relevance of history there? Obviously, if you look over a long enough period of time, we can see some mean reverting tendencies, right? But at the same time, our history is constantly being built, right? We're constantly adding to that and adding to the amount of data that we have on what's going on in the world right now. So, how do you kind of reconcile the long-term history and the relevance of that history with the path that we're on right now?
Yeah. So, on the one hand, as I mentioned before, we're at a period that's really unprecedented. You can't look back at history, much less the last 3 years, and get a sense of what's going to happen clearly over the next, 10, 20, 30 years. But that said, there is value in history, and the case that I mentioned, how many people have done the very simple exercise of looking at returns, looking at log of prices from, say, a century ago on? And I don't quite start a century ago because 29 was quite an unusual period, but how many people have looked and noticed that it's pretty much a straight line? How many people have looked at volatility over the last 70 or 80 years and noticed that there's like this background radiation level with just bumps up and down? This isn't like rocket science, but people don't think with that time frame. I didn't until I worked with Ray Dalio right as this financial crisis gathered steam before I went to Treasury. And the one thing he taught me is a respect for history. I came in as a pure quant, and during this crisis, he was having a lot of people on the research side study, among other things, the Weimar Republic. And I said, "No, why in the world are you doing that?" But anybody who's read his stuff, you can see that he focuses a lot on history. I don't think you have to go that far back, but you should, along with the exercise I suggest to these Master of Financial Economics students, look at all the crises that have occurred from, say, 1960 on or whatever, and try to understand, find out for each of them what happened. Why did that happen? That way you're armed with some sort of perspective and some sense of experience so that you don't have to face the market as just a mass of numbers. And if you talk to a senior person, I'd say also if you're a younger person, that's even more important because the senior people that you'll be talking to have lived through a lot of this stuff. I'm probably older than a lot of people that somebody may work for, but I was right in the middle of the trenches during 87. I was sitting there during the Volcker rule and, when rates were up at 14% and people are going crazy. And then there's LTCM and there's 2000, there's 2008. I know them, I've lived them, and probably the more experienced and senior people have as well. So somebody who's younger ought to get to know and have a feel for the nature of how the markets have been so that they can, act on with a similar sense of experience and insight.
Absolutely. Yeah, learning that history is so important and really not just learning, but I think understanding it in the way that yeah, those who have lived through it understand it, right? I wanna ask, so apart from history, what would you include in the next generation of financial education, say, for the CFA curriculum, for instance? I don't have any control over that, full disclosure, but just if you were asked to recommend something, what would you say are important things that the future of, the financial industry needs to know?
Well, I'd say move from numbers to narrative. The decisions that are made with people sitting around a table talking about things. Now, they may have a risk report in front of them, but it's just the nouns and verbs for what they're doing. The second thing is moved from financial to physical. What's going to matter more and more going forward, and if you're again, in an asset owner realm, is what's happening in the physical world and its risks and how it's developing as opposed to financial. The other would be moving from statistical to structural. Basically, if you went back in time, pick any time between the mid 1990s and today, and somebody, you sort of put you in a time machine, sat you there and gave you a risk report, you wouldn't be able to tell based on the analysis where you were sitting. We're using the same risk methods now with a few little embellishments that we had in the late 1990s and 2000. So the statistical is kind of there. And it's good if you want to know best guess of what will happen next week. But the structure of the system is what really will matter for risk further along. And then finally, it's going from the mechanical or the mechanistic to the human, which again, I could have said this 5 years ago and somebody say, "Okay, great. Well, what do I do?" Now you can do it. We have the tools to look at the market more in a human way. Agent-based models were the foot in the door to do that, to recognize that we're heterogeneous agents, that when we act, it has an effect on the market. But now we can add another dimension to that because with artificial intelligence and LLMs, we can do a reasonable job of moving from mechanistic agents to agents that fairly closely mimic what human behavior would do in those circumstances.
Rick, thank you for joining us and for helping bridge theory and practice, and for reminding us that in finance, at its core, it's a human system in the end of the day. So it has been a pleasure speaking with you. Thank you so much. This has been the Enterprising Investor Podcast from CFA Institute. I'm Genevieve Heyman, and you can read more about complexity and systems thinking in our latest report, Reframing Financial Markets as Complex Systems, available at rpc.cfainstitute.org. Thanks everyone for listening.